Imagine this for a moment. You wake up, you check the markets, and silver has absolutely skyrocketed. The price is hitting all-time highs, numbers you've only dreamed about. On paper, you're wealthier than you were yesterday. But then you try to sell, or maybe you try to buy more, and you find out you can't. The websites are down, the phone lines are dead. The entire global market has just stopped. It's not a technical glitch, it's a freeze. This isn't just a fantasy scenario, it's a possibility rooted in the very mechanics of the market. And today, we're going to break down exactly how it could happen. Welcome to the Bullion Signal podcast. This is the place where we cut through the noise of daily market chatter to give you the bigger picture on macroeconomics, precious metals, and how to preserve your wealth in uncertain times. If that sounds like what you're looking for, go ahead and hit that subscribe button because you won't want to miss what's coming. Now let's talk about the specific number that could break the system.
$62.30. Let's just call this the magic number, or maybe the cursed number, because in this scenario, this is the price point where the entire complex global machine that is the silver market just seizes up. Now, basic economics tells us that a high price should bring a flood of supply, right? Everyone who has silver should be rushing to sell and take profits. But what if the opposite happened? What if that price triggered a complete and total market paralysis?
And that really is the central mystery we're diving into today. How on earth can the highest price in history cause the supply of silver to evaporate overnight? It's a paradox that seems to defy every rule of supply and demand we've ever learned. It's not just counterintuitive, it feels impossible. But when you look under the hood at the plumbing of the financial system, you find the weaknesses. You find the exact points of failure that can lead to this kind of shutdown. So let's get into it. So the first thing to understand is what this freeze looks like on the ground for you, for me, for anyone trying to transact. The market becomes what's known as bid only. You've got an ocean of buyers out there screaming to buy, waving cash, putting in bids at $62, $63, $65, but there's no ask. The other side of the equation, the sellers, have simply vanished. It's like going to a supermarket where every shelf is full, but none of it is for sale. And this quote right here gets to the heart of the psychology behind the freeze. This comes from a major bullion dealer, a business whose entire existence is based on selling metal. They're looking at record high prices, the biggest profits of their lives, and they're saying, no, we're closed. Why? Because a terrifying thought has entered their minds. If we sell you an ounce of silver for $63 today, what if it costs us $70 to buy another ounce tomorrow to replace it? They're no longer thinking about profit in dollars. They're thinking about the survival of their inventory. But the problem goes much, much deeper than just the dealers. To really understand why the shelves are empty, you have to go all the way to the top of the supply chain. You have to look at the factories, the refineries, that actually melt down raw ore and produce the shiny silver bars we all recognize. This right here is where the initial short circuit happens. Okay, let's walk through this carefully, because it's the linchpin of the whole collapse. A refiner is not a speculator. They're a manufacturer. Their biggest fear is price volatility. So when they buy $1 million worth of raw silver ore from a mine, they immediately do something on the futures market. They sell a paper contract for that exact same amount of silver. This is called hedging. It locks in their profit margin. If the price of silver goes down while they're refining, they lose on the physical metal but make money on their paper short. If the price goes up, they make money on the physical but lose on the paper short. It's supposed to balance out. But what if the price doesn't just go up a little? What if it explodes vertically? Suddenly, their paper short position is bleeding millions of dollars an hour.
And that leads to this killer mechanism, the margin call. The broker who holds that paper short position calls the refiner and says, you have catastrophic losses on your account. We need millions of dollars in cash right now to cover them. The refiner says, but I have the physical silver. It's in my furnace. It's worth more than ever. But the exchange doesn't want silver. They want cash. And if the refiner can't deliver that cash immediately, their only option is to hit the emergency brake on their entire operation. They stop buying ore, stop refining, stop everything to prevent the paper losses from bankrupting them.
And this quote just perfectly captures the insane paradox of the situation. The very financial tool that was designed to ensure a smooth and stable supply chain, the hedge, has now become a suicide pact. The high price that should be the ultimate signal to produce more has instead sent a signal to shut down completely. The engine of production has seized at the moment of peak demand.
So, with the source of new silver completely cut off at the refineries, you can imagine what happens next. A catastrophic wave of failure starts to ripple down the entire supply chain. What happens to the wholesalers, the distributors, the retail dealers? They are all totally dependent on that steady flow of new bars from the refineries. And now the tap has been turned off.
For every single person in the business of selling silver, this one term becomes their waking nightmare: replacement risk. It's a simple but terrifying concept. They begin to realize they are holding a rapidly appreciating asset, and the market is offering them a rapidly depreciating paper currency in exchange for it. Selling their silver for dollars suddenly becomes the riskiest move they could possibly make. They could sell out their entire inventory and find they don't have enough cash to buy even half of it back a week later.
And this slide really lays out the impossible choice they face. Look at this. On one hand, you can sell now and realize a massive profit in dollars, maybe the biggest payday of your career. But the risk is that you can't replace your inventory, and you're effectively out of business. On the other hand, you can hold on to your inventory. Your net worth on paper keeps going up as the price rises, but you have zero cash flow coming in. In a true market panic, a crisis of confidence, there is only one logical answer. You hold the metal. And just like that, every dealer in the world pulls their inventory off the market simultaneously. The situation for the middlemen, the wholesalers, is even more apocalyptic. You see, many of these guys operate on a just-in-time inventory model. That means they sell huge amounts of silver to dealers that they haven't even received yet from the refinery. They're counting on that next shipment to fulfill their orders. So when the refinery calls and says, "Sorry, we're shut down," that shipment is canceled. They are instantly catastrophically ruined. They are now short millions of ounces of physical silver that they owe to their customers and have no possible way to acquire. This entire supply chain breakdown leads us to the final, most chaotic phase of the crisis: the Great Divorce. This is where the price you see on your computer screen, the paper price, completely detaches from the real-world price to actually get your hands on a physical ounce of silver. The number on the screen becomes a work of fiction. And here's why. While you and I are locked out of the market, the industrial giants are in a state of absolute panic. Think about it. A company like Samsung or Tesla can't afford to shut down a multi-billion-dollar factory because they can't get a few thousand ounces of silver. The cost of shutting down is infinitely greater than any premium they'd have to pay. So they bypass the entire broken retail system. They start calling warehouses directly, offering $70, $75 an ounce, whatever it takes, for immediate delivery of large industrial bars. This action vacuums up every last drop of available supply on the planet. Now, this is where things get really dangerous for anyone who believes they're safe because they own a paper-silver product, like an ETF or a futures contract. Buried in the fine print of those contracts is almost always a clause called force majeure. It's basically a legal escape hatch. It allows a company to break its promise to you because of an act of God, or, more importantly here, an unforeseeable and extraordinary market event. And this is the ultimate trap of the paper markets. When your ETF provider or the futures exchange declares force majeure, they are telling you they don't actually have to deliver the physical silver they promised. Instead, they can just close your position and send you a check. They can cash settle you. And the worst part is, they can do it at a price they determine, like the old frozen price of $62.30, while the real physical price continues to soar out of reach. You get cashed out, and they keep the metal. This slide really just sums up the new reality perfectly. We now live in a world of two silver prices. There's the spot price, which is just a ghost. It's an artifact of a broken paper market. And then there's the physical price, the real price, the price that industrial users are desperately paying to get actual metal in their hands. And that's the only price that truly matters anymore.
So where does this all go? What happens when a commodity that is essential for thousands of industrial applications becomes, for all practical purposes, impossible to get? Well, it enters a new phase. It starts to be treated like something from a science fiction movie. It becomes unobtainium.
I love this concept of unobtainium.
because it perfectly describes the psychology. It's when price no longer matters in the demand equation. Think about it. If you're Apple and you need a tiny amount of silver to make a $2,000 laptop work, are you going to stop production because the price of that tiny amount of silver doubled or tripled or went up by 10 times? No. You will pay absolutely anything to get it. When silver reaches that point for enough industries, its price doesn't just climb, it goes vertical.
Now, you can't expect the regulators and the powers that be to just sit back and watch this happen. As the physical market breaks away and the price goes parabolic, they will bring out their emergency toolkit. They'll do things like hike margin requirements to astronomical levels to force speculators out. They might impose position limits, making it illegal for you to buy more than a certain amount. They could even try to relabel people who own physical metal as hoarders and threaten them with windfall taxes. But here's the key thing to remember. None of these actions can create a single new ounce of physical silver.
So how does the price actually find a new level? This projection lays out a potential three-stage rocket. Stage 1 is purely technical, a gamma squeeze, which is basically a vicious feedback loop in the options market that forces prices higher in a spiral. Once that gets going, you hit stage 2, the media mania. Suddenly, the silver crisis is the top story on every news channel, and the general public rushes in, trying to get a piece of the action. And that all leads to the final stage, industrial capitulation. This is when major corporations give up fighting the price and start desperately hoarding the metal at any cost, even issuing new debt just to secure their physical supply.
Now, this is probably the most important strategic point in this entire discussion. If a scenario like this actually plays out and silver hits, say, $100 an ounce, that is not a signal that you've become rich in dollars. It's a fire alarm screaming that the dollar itself is in deep, deep trouble. The goal in this environment is not to accumulate more paper currency. The goal is to preserve and increase your real-world purchasing power. Selling your real asset for a failing currency is a classic loser's game.
So the strategy has to shift from selling to swapping. You don't sell your silver for cash. Instead, you might trade your now very valuable silver for more stable monetary metal like gold, especially if the gold-to-silver ratio has fallen dramatically. Or even better, you bypass currency altogether and trade your metal directly for other tangible, productive assets, a piece of land, an income-producing business. You're trading one form of real wealth for another, keeping yourself outside the failing currency system.
And that really brings us to the final question we should all be thinking about. This entire scenario forces us to rethink what price even means. When the official market is broken, when the screen price is a lie, and when a vital industrial commodity becomes almost impossible to acquire, what is its true price? The answer is, its price is whatever someone in the real world is willing to trade for it. It might be 10 barrels of oil, a month's worth of food, or a deed to a piece of property. The price becomes real again. And on that thought, we'll wrap up today's analysis. If you found this breakdown valuable, the best way to support the channel is to hit that like button and share this with someone you think needs to see it. And of course, make sure you're subscribed to Bullion Signal Podcast for more deep dives into the forces shaping our financial world. As a final reminder, please remember that everything discussed here today is for informational and educational purposes only. This is not personal, financial, or investment advice. You should always conduct your own thorough research and be responsible for your own financial decisions. Thank you for joining me, and I'll see you in the next one.